What's up guys, welcome to this weekend market internals. Today we're going to go check under the hood of the market again to search for some extremes in the internals. Let's start by reviewing our call from last week. As expected, we closed the week green, although not quite as high as we had hoped given the standard deviation ranges. Regardless, it was a successful week showing a small increase in the mids of multiple bank run and a sticky CPI, with many predicting a market crash and buying put protection. I told you right here. Beautiful green candle on the weekly. I told you guys to be careful on the short side. During our last video, I explained why. We discussed the overall internals and the potential to bounce back inside extreme standard deviation. And by the way guys, this is the video right there. You can go look it up. You will understand the entire thought process and why we basically bounce from where I told you guys that we were gonna bounce on the second standard deviation on the daily, and in the same time we were also on the second standard deviation of the 4-hour guys. Maybe off by $1. I was off by $1. I'm sorry. Okay, so now looking at the technical side for next week, we still have more room to the upper band on the standard deviation on the 4-hour. In my humble opinion, we could still go back up to about here guys. In the last video, I cautioned you about the extreme bearish sentiment in the market after the bank collapsed, and I would also caution against this week's bearish sentiment. Alright, so let's dive in the put call intrinsic value to see how the market participants are positioned. As you can see, there is way more put buying than call buying right now, which makes the short-term pain trade to the upside, which is the max pain right here. The market is very well hedged for this week, the 24 expiration into this upcoming economic calendar right here. Market participants are long more puts than calls for two main reasons. One, in case more bank fail next week, and two, protecting themselves from the upcoming economic data release. We have the FOMC rate decision, which has a very high trading impact right here. We have the existing home sales, also trading impact is very high. We have the initial claim, continuing claims, new home sales. This one I'm actually very intrigued to see. New home sales, all of these are correlated to inflation. Naturally, there is going to be a higher demand on the put side for this type of week. If there is no other new bank issues this week, no other bank collapse, everything is okay guys, and the Fed sticks to 25 basis points, that in itself will be a bullish catalyst. Let me explain. The market doesn't care about the news. It can process good and bad news as equal. What they dislike is the uncertainty of what the news can be. Once the uncertainty is priced in the market, we go higher guys. It's that simple. The lack of series of fresh new bearish catalysts all of a sudden will become a bull catalyst in itself for next week. Next week, the only bullish catalyst we need is no bearish news. No other bank failing, no other regional bank having issue, no liquidity issue, 25 basis point from the Fed. The Fed can even be hawkish. It won't matter. Then all the put holders will start selling their puts, which will trigger the market makers to buy back the futures in their inventory they are short on to hedge against their initial short put position. And then it becomes a self-fulfilling prophecy. I also wanted to quickly show the expected move for next week in the option chain, which basically the option chain is pricing in that we are going to be between 418 and 379.80 guys. Right here, this is the expected move for this coming week in the markets. Alright, so let's finish this section by looking at what retail is doing. I like to track TQQQ and SQQQ, which are popular retail directional leverage ETF, to see what retail is doing with their money. So as you can see in TQQQ, the net flow is slightly negative. Basically, retail is not buying right now in the market. They are not bullish whatsoever. This is telling me that retail is also pretty bearish on the market right now. So now let's look at SQQQ. As you can see, it's also slightly negative. Retail is also not super bearish. I would preferably like to see some positive flow into this so we can continue squeezing a little bit higher before we do have that big leg down that I'm looking for. Alright, we're going to jump right in the internals. This is the overall sentiment positioning of retail and institutions right now. We can clearly see that retail is capitulating and that institutions are accumulating. This is confirming the popular retail leverage ETF fund flow we just looked at. So right here you can see the blue line, that's smart money, they are now buying. And the red line, which is the money, is now finally capitulating and buying a lot of puts, hoping for a market crash. That's why it probably won't happen. We are at a good level to start forming a base for a short-term leg up. So as you can see right here, this is the smart money, dumb money confidence spread right here, and we are now officially again at the same extremes than the October and June low. So this is the AAII Bull survey, which is basically showing you that it's extremely bearish out there, guys. Okay, I'm sorry, but I think we're gonna pop. I think we're gonna rip. We minimum, in my humble opinion, we're probably gonna retest the 400 again. I would not be surprised. This is way too bearish. And then eventually, right, then you're gonna have all the bulls again. They're all gonna be partying. Everyone's gonna think, oh my god, we're going back up to the all-time high. And afterwards, that's when we crash, guys. Okay, this is the risk appetite index, and you can see how sharply it went down right here. Meanwhile, look at the price action. We did go down, but it wasn't that aggressive. But you can see how aggressive the risk appetite index fell. And now it's again in the same zone where, you know, you want to accumulate and you want to be buying. And right now, everybody and their grandma is bearish. Market's gonna crash. They're all looking at the analog of the 2008. And look, I like that analog. You know what I'm saying? Bigger picture, I'm bearish, but short, medium term, I'm still bullish. I'm sorry, guys. I'm still bullish, man. Like I'm looking at this, and this is just a perfect recipe for a nice, beautiful short. And then a lot of people are gonna FOMO, and yeah, just the good old usual. All right, so now let's look at the commercial hedgers. This is very important to look at because it basically shows you what the commercial hedgers are doing, aka the big boys. And as you can see, they are net long treasuries right now, and they are pretty accurate too at timing the tops and the bottom. And this is why you want to pay attention to what these commercial hedgers are doing. As you can see right here, they were net short at the top before we had this big downtrend, right? They were net long here at that bottom, here again, net short right here, right? So you can kind of see that they are pretty good at their job. This is the two-year treasury, two-year treasury as well. Same, they're net long. Right here we have the hedge fund exposure to bonds, which is kind of interesting because they actually don't have a lot of exposure to bond, which is kind of weird because the best time to buy bond is when the yield curve is inverted. So basically this is saying that most hedge funds probably think that rates are going to go higher for longer. Personally, I already have a position. I already started since the October low. It hit some of the standard deviations. And I hope that it goes back down so I can add more to my position. Right here, this is the gold hedgers position. Right here, they are also net long as well. They're not as aggressive than the other securities, but still interesting. They're still net long. And crude as well, very interesting crude. I haven't looked at crude for a very long time right here, and you can see that, this is starting to look dangerous, guys. It it could have a nice starting to curve. You know, they're all in their net long as well, and which is very interesting. Yeah, and right here we have the S&P 500 combo hedger, which is basically the combination of all type of commercial hedgers on the S&P 500, guys. And as you can see, they are net long, guys. They're not betting against the market, and you can see that they're pretty good, man. They were net short right here at the top of the cycle, basically, of the market. They were net long as well during COVID, the low of COVID, and right now they're doing the same. So, you know, I don't think we're done going up, guys. I just don't. So the last part left, the actual market internals that I like to use to find extremes in the market that coincides with major tops and bottom. So I wanted to start with the SPY liquidity premium, which is very interesting to look at. As you can see, it has been very accurate at finding major bottoms, guys. Okay, and this is basically just a very simple calculation. It calculates the difference of volume in the ATF, the SPY, of the volume, and it compares it to the volume of the specific stocks, of the 500 stocks inside of the ATF. And most of the time, when there's more volume in this ATF, in the SPY, than the actual stocks inside of the ATF, well, it coincides a lot with a major market bottom. And right here, guys, we're, in my humble opinion, we're on a major bottom here, and I think we can squeeze up, guys. Yeah, and a lot of people are gonna get caught off guard. And like I said, the pain trade is to the upside. This is the 10-day breath, which I always love to use. You can go look at the other video I did last week. This is why, by the way, guys, I called for a rally last week, is because we were massively oversold, and we're still not in the upper level. This is the 50-day average as well. This is another reason why I am still bullish, guys, because we are still, you know, at the same extremes than the October low and the June low, guys. Obviously, we could have a market crash, you know, but the probabilities are really, really slim, guys. Okay. This is the SPY percent RSI that I also like to use, and as well, this is another reason why, when I was looking at the extremes, you know, we were at an extreme when we were at this low. This is why I called for a nice rally. I thought we are gonna push a little bit higher than this, but you know, it's better than nothing. And yeah, we still don't have readings of extreme greed to the upside. It's the red line, basically. This is the 70 on the RSI, and you can see it. It's pretty good at calling tops. And the blue one is when it's oversold, it calls the bottom. And yeah, I'm just not seeing another leg down, guys. So that's pretty much it, guys. All right, have a good one. Stay blessed.